Thank you very much for these kind words of introduction. Thank you very much for the invitation to come here and to talk about this very interesting and important topic, and the possibility, the opportunity to augment what Mayor Scholz has just said. Many of his points I agree with, but I will focus a little bit more on the euro crisis and on its reasons, on ways to overcome the crisis, and on the prospects for the next years to come. But before I do so, let me just congratulate the young people in the room. You are studying here far away from home, but you are able to have information immediately from home. I just checked. My team Borussia Dortmund won, so I can be very relaxed. When I was studying here some 25 years ago, you had to wait until the Frankfurter Allgemeine Zeitung reached the Firestone Library, Tuesday, Wednesday, or something like that. You would get the scores, and the next day you got the teams going to the scores, so you could put them together and know what happened. Now you have much information, or many pieces of information immediately at hand. And still, if you don't get the fundamental things right, it's difficult. And I think that's one topic in this conference. It's very difficult to understand what's going on, to put things into perspective, and to understand what political choices are available, what can be done to resolve problems, what can be done to initiate progress. And the euro crisis is a particular example of such an information overflow. When I talk to people in an international context, very often many aspects or many arguments are put forth which don't make sense, because, as Mayor Scholz said, we have an entity sui generis with the EU. We have something that has to be understood in its composition and its choices, and in particular in terms of the choices and preferences of all the participants in this entity. And it's not just a federal state that needs to just look at the United States or other examples in order to find out how to proceed. No, it's much more complicated. And with that background in mind, I would like to characterize the current state of affairs in the euro area as an ambivalent state. On one hand, we have reasons to be confident, hopeful for the future, and on the other hand, we have reasons to be very highly concerned about its prospects. My title, if I would have to give one for a paper, would be "It's time for more subsidiarity, more adherence to subsidiarity, and it's not time for complacency in the euro area, and it's not time to touch-ups or for touch-ups of superficial integration. If integration is achieved, that's a great thing, but it needs to be serious, and it needs to be fulfilling the requirements that you would want to have fulfilled. Half-hearted reforms in terms of more integration won't help. I would like to structure my remarks in basically in three sections. One would talk a little bit, and just briefly really, would just sketch, I think, the causes of the crisis, the origins of the crisis. I think you have heard a lot about that, and on the other hand, it could be a topic for a 2-hour presentation. So let's just talk a little bit about the causes, and with that in mind, before that background, talk about the current state of affairs. And then I will address 2 other points in the other 2 sections, and both are very intimately related. They concern the long-run architecture of the euro area. What should be done to strengthen this European house? How should it be set up so that it's more stable than it has been before, avoiding the mistakes that we have made in the first years or in the original construction? On the other hand, the 3rd section will be, what is a viable bridge into this future? Because, of course, you have to distinguish between what you would like to have in the long run in order to have a sustainable architecture from what you have to undertake in order to overcome a crisis, which is very much a different affair. So in a sense, there is no German economic position, but if you want to have a caricature of a German economic position, you would always associate it with principles, led by stringent principles, but maybe dying in the process, but dying in beauty. And the other Europeans often have a very pragmatic approach. The next day, to survive the next day, that's the major thing. Let's wait for the other day. Tomorrow will be another day, as a famous film quote is from, you don't know this movie anymore, Gone with the Wind. Some of us do, yeah. But in the end, by muddling through a situation, you might have foreshadowed already the next process or the next problem in the making. So these are the three sections. In a nutshell, the story goes like that. We have, at the start of 2014, we see a euro area that has overcome a 6-quarter-long recession. The current forecast that we have offered or published in November 2014 for the euro area is about 1.1% of growth, real growth next year, something over 1%. Let's not pretend to be too precise there, something over 1%, which makes a big difference to last year, which saw the euro area shrink by almost 0.5% in real terms. And if you ask European leaders, when you meet them, when you have the pleasure of meeting them in some conferences or so, you often get the impression that their take on the situation is that it's basically the whole deal. We need to have some touch-ups here and there, but we are really out of the crisis. This is now over. And this, at least a position taken by some, this would be a wrong position to take for two reasons. The one reason is that the crisis countries admittedly have made a lot of reforms, have undertaken a lot of reforms, have made much progress, uneven, albeit it might well be regarded as an uneven progress, but nevertheless there has been a lot of progress. But the problems that had been accumulated before the crisis are so huge that overcoming them is an affair of several years. They are so substantial that even now, after some progress, there is even more reform effort needed. And as long as these reform necessities are not put into implementation, are not overcome, we have still low growth prospects in many of these countries, and you can only grow out of this crisis, decrease debts in private and public terms if you have sufficient growth. And the second reason is that, admittedly, European policymakers have done a lot to re-strengthen the European area architecture. We have seen a lot of reform to European institutions, and one was mentioned before, one very important one, that was the banking union. And nevertheless, it is in its making. How it is implemented, how it's going to be implemented, will decide on whether it's really helping us in terms of long-run sustainability. The big problem with the reform of the European area architecture so far has been that there's no really transparent, obvious, overarching strategy that is pursued. It has been a piecemeal, step-by-step, reactive approach, leading more and more into a direction of strengthening the original idea of the Maastricht Treaty. So it's going more and more towards the concept that I will introduce in the section, the Maastricht 2.0, that basically is our concept. The German Council of Economic Experts concept is Maastricht 2.0. If you look at what has happened, not because they like our ideas so much, it has just happened that many of the ideas that we have outlined in this concept are now also put into life or brought into life by the reforms on the European level. But at the same time, you see by the European Commission, by the 4 presidents, you see 2 reports recently that have been published last year, which ask for more integration, fiscal capacity, joint unemployment insurance, and things like that, which are going counter Maastricht 2.0. So what's going on? What's happening? nobody really knows because there is no real overarching strategy. Especially, we see an impasse in the bargaining over the distribution of the burden that has been accumulated. Somebody has to pay off this debt, but of course it's a bargaining game between fiscal sovereigns who is taking up the debt. There's no doubt really from an economic point of view, or an economics point of view, that the fiscal side would be responsible to work off all these old debt. Not the monetary policy would be responsible. But European policymakers have stood aside passively during the last years, somewhat passively or even tacitly welcomed, admittedly, that the ECB intervened. Now, the ECB intervention has done a lot to save the day, but it has also altered incentives quite a bit, because with the reduced interest rates on fiscal, government debt, with the reduced interest rate spreads, also the reform necessity or the immediacy of engaging into reform has been reduced. And that, of course, bears its own seed of future problems to come. Now, my conclusion will be that progress in the euro area can only come from the national governments in the moment. They have to adhere adamantly to their reform paths, to what would have to be done to factor in good markets in terms of structural reform, and they need to adhere to, and that was also one theme in the first keynote, they would have to adhere to their consolidation plans. Germany cannot really do much more than offer solidarity when it's needed, but there is no grand solution. So when from abroad sometimes we hear voices which say that Germany is basically at fault, that progress is so slow because Germany could do much more by taking up more burden, by increasing its own domestic demand and so on. That's difficult because if you look more closely, it's not really there very much what Germany can really do apart from being a good example. And that will be basically coming full circle to, at the end of the discussion, that I'm somewhat concerned that Germany is not fulfilling that role in the moment with its current policy. So let's just take a step back and ask ourselves what has been the reason for the crisis. So the reasons have been manifold. And basically what we have seen in world economic growth is something that in one interview at one point I coined the term Kratochvilova syndrome. It hasn't really permeated the popular culture actually. But what I meant was, do you remember Jarmila Kratochvilova? Jarmila Kratochvilova was the Czech track and field athlete who was very muscular, very athletic, and who still holds, despite having set the records in the 80s, still holds the record, world record for the 800-meter track and field. And she held very long the 400-meter record, until Marita Koch, I think, an East German athlete, took it away from her. So the point is, why are, despite all the progress in training techniques, in nourishment, in nutritional information and so on, why are these world records still standing? Obviously, or at least it's very, very likely that it has something to do with medication, with doping. And you have achievements that you see in the record books which are not real achievements in the sense of being in the realm of human ability. And that's basically the same thing with growth that we have seen before the crisis. It's what debt-fueled. Not all the growth rates that we saw in Ireland, in Spain, for example, were real growth rates. They were just growth rates that were accounted for. But of course, when the bubbles bursted in the housing market in Spain, or when when the truth became revealed, then they were just revealed to be fake and not overblown growth rates. Now we were left with three intertwined areas of crisis coming out of this realization, namely a sovereign debt crisis, a banking sector crisis, and a crisis of international competitiveness. And let me just be a bit superficial here. Of course, countries' economies cannot be competitive or not competitive. It's the enterprises that are located in these economies which are more or less internationally competitive. But let's just go over that a little bit superficially. These three crisis areas were intertwined very much because, of course, if you have to help ailing banks in terms of when a government has to help its ailing banks, then of course its debt situation deteriorates. On the other hand, if you provide a lot of liquidity to banks, like in the LTRO program, the ECB handed over €1 billion at the beginning of 2012 of liquidity to the banking sector, and the banks don't do anything else but buy the government bonds of their own countries, of the countries they are located in, then of course the entanglement between states and banks becomes worse. And of course, if you have to have restructuring in the factors and goods markets, especially if you are setting or betting on newcomers, new enterprises blooming and growing, then you need, of course, the finance. But if the banking sector is ailing, this finance is not forthcoming, and therefore the structural problems are becoming worse if the banking sector does not function. All these different crisis areas have been very much described and analyzed. And if you like, you could, for example, read a paper in International Tax and Public Finance published last year, where I condensed what we have written in our reports from the German Council of Economic Experts over the last couple of years, last 3 or 4 years. I have some copies, if you are really interested, of our executive summary from the last report, where some of these things are mentioned. But nevertheless, this is something that really is understood quite well. What is not understood quite well is how these three crises, these three intertwined crises, generated a systemic crisis. And it's actually very highly debated whether what we have seen in the accumulation of problems in the summer of 2012 was just a reflection of individual countries having problems, some more, some less, Germany less, Italy, France, Spain more, even big countries not being under the rescue program umbrella, but displaying problems of refinancing themselves at palatable interest rates. Some would still argue, for example, the German Constitutional Court followed these interpretations, would argue that it's all a reflection of individual problems. But we have seen we have concluded in our report from 2013, we refer to a study that empirically looks at the issue. We have concluded that there's somewhat more to it. There's another element. And this new element that basically has to be will revolutionize German ordnungspolitisches Denken. You all heard the term. The expectations don't play a role there. But if you have multiple equilibria, if you have an equilibrium where everybody believes in the euro area is stable and its integrity will be adhered to, and another possible equilibrium where everybody is thinking, well, it might go wrong, it might disintegrate, and because everybody is thinking that, it will happen. If you have a situation like that, then of course the European Central Bank, as being the monetary authority, might be able to coordinate the expectations away from the bad equilibrium to the good one. And that's what probably the European Central Bank would argue has been done, or it has done, with the outright monetary transactions program in the summer and fall of 2012. Now, be it as it may, whether this interpretation is the right one or not, what has happened is that interest rates have really declined and have been put back into a small band near to the German rates. And at least in the short term, that has led or has supported the recovery that we have seen. We have not only interest rate spreads declining, we have emergency liquidity assistance to banks in the periphery declining from their national banks. We see that banks repay early the LTRO loans that they have received in 2012 and so on. But it's not a self-sustaining recovery. It's a recovery that only survives because monetary policy is still expansionary. But if OMT, if monetary policy was the whole story behind it, we would be really in trouble, because monetary policy can only offer temporary relief, not structural reforms. Structural reforms have to be done by those responsible for them. And fortunately, you see there is progress in the euro area. That's something that German economists are not really agreeing on. Some German economists would say Greece and other countries don't do enough. I disagree. We as a council disagree. If you look more closely, you see the current account balances in these countries, in the peripheral countries, have been improving. And that's not only a reflection of reducing imports. That wouldn't be a success. But it's also a reflection of starting export sector to develop. Sectoral restructuring away from domestic from non-tradable to tradable sectors is happening. But there are still stubborn obstacles to recovery. And most importantly, unemployment, as you mentioned already, is one of the big problems. And labor market reform needs to break this divide between privileged and non-privileged workers in those countries that have developed dual labor markets, where you have a privileged elite and a set of marginal workers who bear all the burden of adjustment. And of course, the banking sector has to be relieved. That brings me to the long-run architecture. How should the long-run architecture be structured? Well, it would need to be one, in the ideal, that avoids making the mistakes of the past. One mistake, obviously, has been that we didn't have enough precautions against the crisis emerging. And the other one was we were not prepared how to deal with the crisis once it comes about. And that's where the no bailout principle comes in. Obviously, most participants, most actors didn't think that the no bailout principle was really credible. And they were right, because when the crisis erupted and some countries asymmetrically had more problems than others, there were, in principle, there are only 3 safety valves available. In principle, there are 3 safety valves in the currency union available. One is exit. And I agree with you that exit cannot be an option in this context. To put the European integration process on hold would definitely mean perhaps to destroy it altogether, but it would not just be something like I move an enterprise from the enterprise roles, I just deregister, and 3 years later I register again, everybody is happy. That's not how the real world works. That might be the business world that works like that, but it's not like that in the political process. Once we push out Greece or any other country, once Germany would even dare, I mean, that's really impossible because of all our history, I think. But if we were pushing one country out of the euro, that would be probably the end of the integration process that we have seen so far. So that's not an option. And whether I think so or not is irrelevant, because certainly I think all responsibles in German policy will not disagree with that and will do everything probably to save the euro area integrity. So the second possibility would be, well, a sovereign could be defaulting. You would have to have an orderly restructuring of sovereign debt. There was no such provision. Because of that provision not being there in the crisis, that was not a route that anybody dared to take because of all the possible consequences and repercussions of that. So in principle, there's only the third valve, and that's helping out one another by giving up on the bailout principle. No bailout principle. But if you give up on that openly, of course, you introduce a lot of incentive problems. And that's the reason why we think that by strengthening the possibilities of European sovereign or of Europe to really survive the default of one of their member states, the partial restructuring of government debt of one of the member states, that in the long term is the avenue to take. And the way to implement that is to re-strengthen the European crisis mechanism. That's something completely different from a transfer mechanism. It's the idea that if you have accumulated a lot of debt as a sovereign that goes beyond the palatable rates set by the European or discussed with the European partners, and you ask the ESM for help, then you need to have to engage also into partial restructuring. That would be the idea that would make the no bailout principle credible. And if you have a no bailout principle that's credible, then of course you can align again control and liability at the same level. This is the basic principle that has been violated up to the beginning of the crisis, and it's now of course violated. Because usually if you control a decision and you bear the liability for taking the responsibility for all its consequences, that's a very healthy situation. If somebody is buying and another one is paying, that's not really a healthy situation. In the moment we have, via all these rescue measures and especially the engagement of the European Central Bank, we have a situation where the community is liable and the decisions are still at the fiscal decisions are still at the national level. Now there are two avenues out of that. One would be a full-fledged European economic finance minister, something like that. That would mean that control and liability are aligned at the European level. And I don't see that in the next years happening. It's just not happening that the French, the Germans, the Italians will give up. The Germans maybe, but I don't see that really on the full Euro area scale, that sovereignty is handed over to the community in fiscal affairs. If that's not credible, then the only way out is to keep liability where the control is at the national level for fiscal decisions, and then have the no bailout principle made more credible by having an augmented crisis mechanism. Now, the alignment of liability and control needs to be taken from a different, or viewed from a different perspective when you look at the financial sector. Because there, the banks that operate, the financial institutions, very much transgress borders. So their control also needs to be at the European level. And the elements that you need to have were outlined in the first keynote. You cannot really rely only on joint supervision. You also need a resolution mechanism, and you need to know who is paying in the end. You need a resolution fund fed by the banks themselves, but you also need to have a provision for what happens when money runs out. How do the fiscal sovereigns then share the burden? And that's exactly what I meant when I said the problem in the moment is that we are on the path to a European banking union, which is good. But on the other hand, if ailing banks are accepted into this banking union with their burden that has to be borne at some point later, that's not really a healthy situation. The European Central Bank will set up this asset quality review, most of you will have heard of, and the idea is that by thoroughly testing who has a healthy business model and is allowed into the banking union and who is not, or which bank has not, you don't run into the danger of accepting old burdens becoming fresh, new burdens, then burdens for the community, the ECB. The problem is that the ECB is in a bind because it knows exactly that if it accepts an ailing bank, then it will be responsible for these problems later. But it also knows if it detects too many ailing banks in the moment, we can get back into a crisis again. So the real responsibility or the real task for the fiscal side at that point in Europe, for European policymakers, would be to provide fiscal backstops for this problem, for this situation, for this contingency. And that's not what has happened so far. Germany has one with the banking fund that is still filled, but other countries have not. So in terms of providing a stable architecture, one would need to have this alignment, and this alignment would have to be at different levels for fiscal policy and for the supervision of banks and the regulation of the financial industry. I didn't talk about, and I won't touch it, apart from maybe in the discussion, what does that mean for economic policy? Do we need a common labor market policy, common social security, unemployment systems? The answer, we think, is no. Because the risk-sharing mechanisms that we have that would be available, other risk-sharing mechanisms are better. For example, cross-border equity ownership would be much more effective. Now let me take my last 5 minutes to talk about the third section, the bridge into stability union. Now, everything that you can say about the long-run stable architecture is referring to a normal situation. What do you do in a normal state of affairs in order to prevent a new crisis from arising and in order to deal with the crisis once it arises? That was the issue in a few minutes ago. But we are now in anything else but a normal situation. Talking about sovereign default for some countries in the euro area at the moment is not really a helpful strategy if you want to overcome crisis and want to instill confidence in the future of the euro area. So you need a bridge. The situation in 2012 was so escalated that the German Council of Economic Experts proposed something that was called the European Redemption Pact, which had two arms. One arm was an arm of solidarity, having basically a European Redemption Fund, it was called, where every country not being under the umbrella, the rescue umbrella, in any member state of the euro area could join this pact and take everything beyond 60% of its own debt, 60% in terms of GDP, and put it, refinance it via a joint and severally financed and guaranteed fund. So it's not a Eurobond because it was a temporary affair meant to work down to redeem these debts until they would run out to be zero at, let's say, 2035. And the stick, the carrot with that was that for countries with high interest rates like Italy, we would have lower interest rates, better ability to refinance themselves, and better ability to also then use these new funds in order to engage into reform. Because there was a second arm for this. That's why it's called a pact, not just a fund. It was an arm of conditionality, asking the member states to consolidate their public finances, use the new, via interest rate reduction, new possibilities to engage into reform and consolidation to actually do so. Why did we think that might work? Because market discipline would always be the big stick with this suggestion. Because if, let's say Italy, because that was the country that was mostly discussed by German critics of this proposal, let's say Italy would default, would renege on some part of its obligations, then the provisions of the pact would always say, okay, now go out to the market and refinance yourself at 5, 6, 7%, and not at the 3% that the joint financing we will offer you. This would be a tremendous incentive, that's what we thought at least, of providing market discipline. Now, that's exactly what is not possible any longer in a new world made by the announcement of the OMT, because interest rates have now been lower, or have become lower, and that means there is no grand fiscal solution of that sort anymore. The idea at the time was to provide the German government with the possibility to be in the driver's seat for further integration, proactively say, okay, we have something, we have a proposal that combines solidarity and conditionality in a quid pro quo strategy like our reactive steps have already done in the last years. Because that's exactly what the German government did. It was offering solidarity step by step, reacting to new crises for changes to the European institutions and so on. This would have been a proactive step, but this proactive step in the moment is not credible any longer because there is no market discipline to be expected since the OMT has changed the world. And that's this ambivalence that was the major theme of the last 30 minutes. In the short term, we have seen relief, and that means in the long term, we might have problems of making the promises come true that state leaders, that European policymakers have made to one another. Now, to conclude, what does that mean for German policy in the moment? Well, as there is no grand solution in the sense that Germany can take up just more responsibility but get something in return, the only thing that are open, the only two aspects that are open to German policymakers is having good arguments and setting a good example. And that's why we as Council of Economic Experts, we are called each year to give an address or to give a report on the state of the economy and to voice concern where we see problems arising. That's why we said, well, what the current discussion about redistribution, forgetting about the reform efforts and reform successes of the Hartz reforms and so on, that's really setting the wrong example for Europe. And I think that in the moment, if you talk in the European context with Spanish or Italian commentators, they are really looking quite puzzled on why Germany has left its path of reform or is leaving its path of reform. Maybe they are not displeased, but I think it's not for the better for them and also not for Germany. Thank you very much.